Okay, class. So good afternoon. I need somebody to confirm that you can see my screen and that you can hear me clearly.
Yeah.
Okay. All right, good. So you're welcome. Today, we are going to start from where we stopped last week, which is on property, plant, and equipment. And last week, we looked at, firstly, what property, plant, and equipment is. And we said a PPE are tangible assets that are held for use in the production or supply of goods or services, for rentals to others, and for administrative purposes, and are expected to be used during more than 1 year. And we explain this definition critically, using it as a basis for the further discussion we had on PP. And I hope that you also have learned this definition and you can mention it by heart by now. Then after looking at the definition, we looked at the recognition criteria for PPE. Now we said there are two recognition criteria. Before you can recognize an item of PPE in your books, number one, we said it must be probable that future economic benefits associated with the assets will flow to the entity. And number two, we said the cost of the assets can be measured reliably. Those were the two recognition criteria we looked at for PPE. Then we moved on to measurement. For measurement, we said this is the amount attached to the PPE that is recognized. We said there is initial measurement, which is the measurement at the date of the transaction. And at the date of the transaction, we said an item of property, plant, and equipment should be initially measured at cost. Then we went on to what cost is, and we said cost comprises the following. We looked at the purchase price, including import duties and non-refundable purchase taxes after deducting trade discounts and rebates. Then it includes directly attributable costs of bringing the asset to its location and condition necessary for it to be operating in a manner intended by management. And these are costs that if you don't incur them, the asset cannot be ready. Those are directly attributable costs. Then examples of those are the cost of employee benefits that are directly involved in the construction or acquisition of the item. Also is the cost of site preparation, initial delivery and handling costs, installation and assembly costs, then professional fees, and cost or testing costs after deducting the net proceeds from sales of samples. We explained all of this critically last week. We also said that it includes the initial estimate of the cost of dismantling and removing the item and restoring the site on which the asset is located. We said this is also capitalized, and we explained how that is achieved. We also looked at an example on that last week. Then we looked at some costs that are not directly attributable costs. First of which was cost of opening a new facility or cost of introducing a new product, which is like cost of advertisement and promotional activities. And also cost of conducting business in a new location, administrative and general overhead, initial operating losses, or pre-production costs. All of these are not directly attributable costs. When you see them, they should be expensed. Then we looked at this question last week. Which we explained. Then we moved on to subsequent costs. And we mentioned that subsequent costs are costs that are incurred after the date of the transaction or during the year. And I told you that the main point there is that, are we going to capitalize this kind of costs or are we going to expense it? For you to capitalize it, it must meet the recognition criteria. And we say that meeting this recognition criteria, how you will know is that they must tell you in the exam that this item has improved the productive capacity of the asset or it has improved the useful life of the asset. We explained all of that last week. Then we went on to subsequent measurement, which is the measurement at the end of each reporting period. And we said you measure an item of PPE either using the cost model or using revaluation model. I told you that the cost model is simply costs less accumulated depreciation and any accumulated impairment losses. And we told you that evaluation model is the revalued amount, which is the fair value of the asset at the date of evaluation, less any subsequent accumulated depreciation and any accumulated impairment losses. We explained this also critically. From there, we broke down these models, this cost model and evaluation model. I told you that at the end of the year, an entity must make a choice. They cannot have the two, they will choose one. And when they choose one, it must be applied consistently. It's not something they can change. Now, okay, we want to change to another model. No, it doesn't work that way. However, we looked at both the cost model and the evaluation model. Both of them are determined majorly by depreciation. And that took us to depreciation. And I explained to you that depreciation is not loss or reduction in the value of an asset. But I told you that it is just complying with accrual concepts or matching concepts. That is what it does. It's just complying with accrual and matching concept, which means that when you buy an asset that is supposed to generate benefit for you for, let's say, 5 years, matching concept says that in each year the asset is generating money for you, you must match it with its corresponding costs. So as the asset is generating benefit for us, the corresponding costs for that asset is depreciation. And also it complies with accrual concept in the sense that when you buy an asset, okay, accrual says that you can only recognize an expense in your books when you have incurred the expense. So when you buy an asset that is you're supposed to enjoy for 5 years, for example, now, when you have used it for 1 year, then it means that you have enjoyed benefit from that asset for 1 year. It means that 1 year portion of that asset, you have actually incurred it. You have incurred an expense when you have enjoyed benefit from that expense. That's when you have incurred that expense. So depreciation is just the portion of the cost of an asset that we have incurred for that year, while the remaining will still be capitalized. And from there, we looked at the definition from depreciation from IAS 16, which says that it is the systematic allocation of the cost or depreciable amount of a non-current asset over its estimated useful life. Then this definition, we looked at it one by one because it has 3 key elements, one of which is systematic allocation. The second is cost or depreciable amount. And the third is estimated useful life. Then we looked at each of them one by one. We mentioned that depreciable amount is simply cost minus residual value. And I also explained residual value to you and why it should not be among the item that we depreciate. That's why they remove it. I also explained to you estimated useful life, which I told you that is not just the number of years alone. Useful life can also be number of units, number of productive units. And also, we also looked at systematic allocation. Systematic allocation, which are the depreciation methods. We explained all of that and some other details to you in our last class. We looked at all of this. And we looked at these examples as well. And I can remember that I gave you this particular one as assignments. And I'm surprised that you did not do it. I'll even be shocked if you even revise stuff. That's not good for us, and that's not good for you yourself. So where we're going to start today, before I come back to this question, I want to finish up with the remaining principles around PPE. So I'm going to start with revaluation of PPE. I'm not sure I did that last week, or did we look at revaluation last week? I'm not sure we looked at.
No, sir.
Yeah. So we did not look at revaluation. So we're supposed to look at revaluation. And also, we end it up with derecognition, then disclosure. So I need to explain that so that we can start solving questions. So let me start with revaluation. Okay, revaluation of PPE. Now, this revaluation of PPE really has to do with when an entity is using a revaluation model. When an entity is using a revaluation model, the entity must revalue that PPE. Because when you are using a revaluation model, the only reason you want to use a revaluation model is that you want the value of the asset to be up to date. You want to keep the value of your asset up to date. So you will now find yourself revaluing the assets. So if you buy an asset 2 years ago for 20 million, and today the value is now 50 million, so you probably revalue it. Then the question becomes, when do you even revalue? So revaluation happens periodically. It could be every year. It could be every 2 years. It could be every 5 years. So there's no specific timeline for revaluing. However, the ultimate principle for evaluation is that the consistency of evaluation or how you revalue depends on the volatility in the value of an asset. If you are in an environment where the asset's value is highly volatile, where the value changes every now and then that means you might most likely be revaluing your assets every year. But if the value is less volatile, maybe you can be doing revaluation maybe every 3 or every 5 years. But the most important point I need you not to forget is that you only talk about evaluation when you have chosen a revaluation model. And when you are revaluing, you are supposed to do this revaluation on a class-by-class basis. I think I explained that last week. Even the choice of this model is on a class-by-class basis, meaning that if you have five motor vehicles now, if you revalue one of them, that means you have to revalue all your motor vehicle. So you don't revalue a singular, it's on a class by class. And when we say class by class, we are talking about all your computer equipment is a class of asset. All your furniture and fittings is a class of asset. All your land and buildings, class of asset. So when you are choosing a model or when you are revaluing your assets, you revalue it on a class by class basis. Now, that's the principle behind revaluation. However, for our exam, whenever they tell you that an entity revalues an asset, the first thing that would come to our mind is that will result in either a revaluation gain or a revaluation loss. As a matter of principle, whenever there is revaluation, the first thing you do is to determine whether there is a revaluation gain or there is a revaluation loss. So let me look at revaluation gain first. So when you have revaluation gain can only occur when the carrying amount of the assets is lower than its fair value or its revalued amount, or when the revalued amount is higher than the carrying amount of that asset, then you would have a gain on revaluation. And when you have a revaluation gain, usually it is an unrealized income, and it's usually recognized in your OCI. It's usually recognized in other comprehensive income. However, all items in OCI, I've told you this before, usually are transferred to your equity. So revaluation gain will end up as equity through your statement of changes in equity. However, if there was an earlier revaluation loss, then in that case, that revaluation gain you get would have to go and net off that loss first. We'll have to net off that loss, because that means that evaluation gain will have to go to P&L. Is if there is any excess, that excess will now go to OCI. This is what I'm saying. Look at this question. They said a property was purchased on 1st of January 2000 for 2 million naira, and they gave us the depreciable amount to be 1 million naira, and they gave us the useful life to be 50 years. Okay, so they purchased it in 2000 and the cost is 2 million. Depreciable amount is 1 million. Okay, they now told us that the annual depreciation of 20,000 was charged from 2000 to 2004, meaning that then I said that, and on 1st of January 2005, the carrying value of the property was 1.9 million, which is after 2004. They gave me the carrying amount. They now went ahead to tell us that the property was revalued to 2.8 million on 1st of January 2005, and they gave me the depreciable amount to be 1.35 million, and the economic life was unchanged. So how do we account for this revaluation surplus? The first thing is this: there was a revaluation. And this property was revalued to 2.8 million on 1st of January 2005. The core thing here is this: you see, at the date of that revaluation, whenever you see revaluation, just identify when is the date of the revaluation. Here is 1st of January 2005. They gave us the revalued amount to be 2.8 million. On that date, you just need to compare this fair value with its carrying amount. In this question, they gave us carrying amount, so we don't have to go through calculating carrying amount, which is cost minus accumulated depreciation. They gave us trade on. So by the time you do 2.8 million minus 1.9 million, that gives me 900,000. So because this fair value is higher than the carrying amount, that means this surplus is this 900,000 is a revaluation surplus, and is going to be recognized in your OCI through, and eventually it go to your equity in your statement of changes in equity. So they will credit it to a revaluation reserve. That's how to determine revaluation. But they didn't stop there. They now said, how do we compute the revised annual depreciation? You see, whenever there is a revaluation, the annual depreciation we are charging is going to change. Look at the annual depreciation we were charging before was 20,000. And this 20,000 is just the depreciable amount, which is 1 million divided by the useful life of 50 years. That's what gave us this 100,000. But since they have revalued it, now the depreciable amount is now 1,350. And they said the estimated economic life remains unchanged. So that means they bought it 2,000 and they revalued 1st of January 2005. If you count 2000, 2001, 2002, 2003, 2004, that's 5 years. So that means that from this date, the remaining estimated useful life is 45 years. Is 45 years. Therefore, the depreciation charge from 2005 onward is simply this depreciable amount given to us multiplied by or divided by 45 years. That is times 1/45. And that gives us 30,000. So two things I'm mentioning here now. The first is that whenever there is evaluation, the first thing we will always do is that we're going to determine either a revaluation gain or a revaluation loss. And all we do is just comparing the revalued amount or the fair value, they can call it any of those names, with the carrying amount. In this question, now the revalued amount was 2.8 million, and the carrying value or the carrying amount is 1.9 million. So when we subtracted it, we got 900,000. And I've told you that this 900,000 is going to be recognized to equity. Okay, it will end up in equity. But first, it is an unrealized gain. It will be recognized in OCI. Then from your OCI, you take it to your equity. However, from the date of revaluation going forward, our depreciation will change because now we'll have a new value. But this question was magnanimous. It already gave us the depreciable amount, which is the amount to depreciate over the remaining useful life of the asset. So we'll do 135 million divided by the remaining useful life of 45 years. And that gives us 30,000. However, you will see that after revaluation, our depreciation increased. It used to be 20,000 before that revaluation, 20,000 per annum. But now, it is 30,000. So you see this increase in annual depreciation charge of 10,000, IAS 16 allows that you should use it to transfer, or you should use it to earn your depreciation. Sorry, you should use it to earn your revaluation reserve by transferring it from revaluation reserve to retain earnings. So this excess amount, this additional depreciation, the standard calls it excess depreciation. And every year, you would make a transfer of this excess depreciation from your revaluation reserve to retain earnings. You will see how that works when we look at few questions later. But doing this, IAS 16 allows it, but it does not require it. In fact, I've not really seen your exam asking you to do this excess depreciation. I've not seen, but I will teach you so that you understand how it works. But I've not actually seen your question asking you to do that. But they know that whenever you revalue an asset, it will lead to an increase in the annual depreciation going forward. Going like in this case now, the depreciation we are charging from the date of evaluation now is now 30,000 per annum as against the 20,000 we're charging. So that difference is an excess depreciation that we usually use to earn our revaluation reserve, to earn it. Since revaluation surplus or reserve are unrealized income, so as we are using it, just use that excess depreciation to earn it by transferring that amount from revaluation reserve directly to your retained earnings. So that's for revaluation gain. Don't forget, what we need to note here is this. When you have a revaluation surplus, it will end up in equity. It's a reserve. But before it goes to equity, it goes to other comprehensive income. Then from there, you take it to your reserve as an equity. However, I told you earlier on that, yes, revaluation gain are recognized to equity. I said here that unless they reverse revaluation losses on the same asset that was previously recognized in income statement. That is, if there is an earlier revaluation loss, meaning there was a revaluation in the previous year and we now had a loss. We now did evaluation in this current year. We now have a surplus. Don't take that surplus to equity yet. Go and use it to net off the earlier revaluation losses. Is if there is now any excess above those previous losses, is those ones that can go to equity. I'm sure it will be clearer when we saw one or two questions. However, for revaluation loss, since it's a loss, anytime you have a revaluation loss, they are recognized in your income statement. Revaluation loss is recognized in income statement. And just like I explained in revaluation surplus, the only time revaluation loss will not be recognized to income statement is if there's a previous revaluation surplus. If there's a previous evaluation surplus, in that instance, you will not go and recognize that loss to income statement or P&L yet. You go and use it to net off against the loss, the surplus in equity. You use it to net off against the surplus. Then if there is now any excess, it is that excess that can still go to the income statement. See what we are talking about here. This example 2 now, it said that continuing from example 1, the question we looked at in example 1, this one now said that at the end of 2006, they revalued the asset. They said the property was revalued in 2006. They now said its fair value had fallen to 1.5 million. They now want us to compute our revaluation loss. Okay. Whenever we have revaluation, the first thing we do is for us to calculate either a revaluation deficit or a revaluation loss. Now, how do we do that? It's just by comparing the fair value. In this case, the fair value was 1.5 million, comparing it with its carrying amount. And carrying amount, don't forget, is just cost minus depreciation or cost minus accumulated depreciation. We already have our fair value in 2006. However, what's our carrying amount? In the last question that we looked at, they revalued the asset in 2005 to 2.8 million, which is now like the updated cost, which is now the new value of the asset. So to get carrying amount is just this cost or this fair value of 2.8 million minus the accumulated depreciation. And I did 2 multiplied by the depreciation per annum. Why? Because we already calculated here that in this initial example, that our annual depreciation going forward is 30,000. Since this revaluation was done in 2006, so that means this 30,000, we will have charged depreciation for 2005, which is the year we had this new value. So depreciation going forward, we charge depreciation for 2005, and we also charge depreciation for 2006. That's 2 years. So the accumulated depreciation till the date of revaluation is 2 years multiplied by 30,000. Whatever we get, when we remove it from this 2.8 million, we get 2,740,000. And that is the carrying amount. By the time you compare this carrying amount with fair value, you will see that the carrying amount or the book value is higher than the fair value of the asset. That gives us a revaluation loss. That leads us to a loss or a revaluation deficit. Ordinarily, when you have a revaluation deficit, it should go to P&L. It should go to your income statement as P or L. But I told you earlier, it might not go to P or L if there is any previous revaluation surplus. And from this other question one, don't forget that we got a revaluation surplus of 900,000 in 2005, 1st of January 2005. So therefore, there is an earlier surplus. Okay, so if I ignore this excess depreciation, I say you should transfer. If we ignore it, that means that this 1.24 million, out of this 1.24 million, 900,000 first will be deducted from equity through your OCI. Is going to go to OCI through from equity, to be done from equity. From your OCI, it goes to your equity. 900,000, just to go and net off that previous surplus. 900,000. And why is it 900,000? Because there is an earlier surplus of 900,000. So this deficit we have now, everything will not go to P&L. 900,000 of it goes to equity first through your OCI. Then it is the excess, which is this 1.24 million deficit, minus the portion of it we have recognized to equity. It is this 340,000 that will have been charged to my income statement, or that will now eventually go to my POL or income statement. And that's that for revaluation losses. If there was a previous revaluation surplus, it will go and net off against that surplus. It is any excess that we are not going to recognize in our POL. In this case, it's 340,000. However, if the examiner has actually told us that they were transferring excess depreciation, that is where they transfer from revaluation reserve to retained earnings. That means, that don't forget, we got our excess depreciation here to be 10,000 from 1st of January 2005. That means they will have transferred that 10,000 two times, which is 2005 and 2006. That means the balance in our revaluation surplus from that question one will have been 880, which is 900 minus 20,000. In that case, it will have been 880 alone that will have net off against this deficit, or will have been net of this deficit only against 880. Then what will have recognized to P or L will have been just 360,000, which is the 1.24 million minus 880. So that's the high-level summary of revaluation. Again, when you revalue, the first thing we usually do is either a gain or a loss. If it's a revaluation gain or surplus goes to my OCI. For my OCI, it becomes a reserve in equity. However, if there is any revaluation losses, it will go and reverse that one first, meaning that we are going to recognize that gain to P or L. It is if there is still an excess over that loss that we are going to recognize that to OCI. Then we looked at an example where they revalued an asset on 1st of January 2005, and they gave us carrying amount. Then we're able to get the surplus to be 900. Then depreciation also changed going forward, which we completed as 30,000. Then I told you that whenever there is a revaluation, it might lead to additional or increase in the annual depreciation. That increase, we call it excess depreciation. And this excess depreciation, IAS 16 allows, but it doesn't require it. It's not compulsory. What we use this excess depreciation to do, we use it to transfer from our evaluation reserve to retained earnings. We just use it to earn our evaluation reserve, and it is optional. It's not like it's compulsory that you have to do that. In fact, in your exam, if the examiner does not ask you to do it, don't even go there. Don't even bother doing it, except the examiner specifically tells you that this company usually transfer excess depreciation. For losses are recognized to POL, except if it's reversing an earlier surplus. And we looked at this example too, where we had a deficit or loss of 1.24 million, which is a continuation of the first example. We did not recognize this 1.24 million to P&L straight because there's an earlier surplus of 900. So it nets off against that surplus. So a 900 of this 1.24 million went to P&L to net off against, went to OCI to net off against the earlier surplus. From OCI, it will end up in equity. So eventually we'll deduct it from our equity. And the remaining balance of 350 is what actually goes to your income statement. However, if you had, this is just an alternative that if we have transferred the excess depreciation of 10,000 per annum for 2 years, the balance in our reserve will have been 880. So what will have been able to net off from this 1.24 million will have been 880, and we will have transferred the remaining loss to P&L of 360,000. Okay, aside this, how do you account for revaluation gain and revaluation losses? The first thing is this, like I've told you earlier on, I've already explained this, that at the initial revaluation, all you need to do is to compare the carrying amount with the fair value. That gives you either a gain or a loss. And all these things I've been explaining earlier on, I've explained it here again, that when there is a revaluation gain, this gain will recognize it to OCI, then it will end up in equity under evaluation surplus. Okay. However, I told you that this gain might be recognized to POL if it's reversing an earlier evaluation decrease. So again, ordinarily, when you have a gain, first it goes to your OCI as a credit. Then the other leg is that if it's a gain, that means the value of your assets will go up. Then you debit our assets. And also don't forget to debit the accumulated depreciation. Because whenever we have a revaluation gain, we will always we will write off the accumulated depreciation till the date of revaluation. So that's why we are debiting this accumulated depreciation. You know, normally accumulated depreciation is always credit. Okay, the reason why we are debiting it here is we want to write it off. Whenever there is a revaluation, write off any accumulated depreciation. So this is how you recognize your revaluation gain. I have already explained this for revaluation losses, that this will be charged to P&L, except if it is reversing an earlier surplus. In that case, a portion of it first will go and net off that surplus through your OCI. Then if there is not any excess, that is not the one that will go to P&L. And that's what they are trying to achieve here, that you might have to debit a surplus if there is a balance in surplus, if there is an earlier surplus. If there's an earlier surplus, you would take it to you would use it to these laws to net it off. Then any excess is what goes to P&L. And accumulated depreciation still has to be written off anytime there is revaluation. And since this is a revaluation loss, the value of our asset is probably going down. Therefore, you credit your assets to reflect that reduction in the value of our assets. And finally is the one I talked about on excess depreciation. Excess depreciation. So IAS 16 usually allows that when there is an excess depreciation, usually when there is a revaluation surplus and the value of your asset goes up, the depreciation you will charge going forward will be higher than what you were charging before because the value of the asset has gone up. This difference between the new depreciation and the old depreciation, we call it excess depreciation. So IAS 16 allows that you should transfer these amounts equally every year from the surplus to retained earnings. So every year you are taking it out from the surplus. That's why we are debiting it, and you are crediting your retained earnings. But you have to be very careful. Don't ever do this transfer of excess depreciation unless the examiner indicates that it is the company's policy to transfer to retain earnings in any excess depreciation. So the question must mention it because it is optional. So if they want you to do it in the question will actually tell you. But if they don't tell you, please don't even go there at all. And in most of your question, we have not actually seen it there. So I gave you some key points for your exams here that whenever you have whenever you have revaluation, the first thing you need to always do is to calculate a revaluation gain or a revaluation loss at the date of revaluation. And I also talked about if the evaluation is done at the beginning of the year, that means the depreciation for that year going forward will be on the basis of the new value. But if the depreciation is done at the end of the year, that means depreciation for that year will still be done on the old cost, because the evaluation is done at the end. And it can be done during the year. Evaluation can be done during the year. So that means there's a way you have to use the old cost up to the date of evaluation and the new value up to the end of the year. When we solve questions, all these are going to make sense for you. Okay, so that is it around for revaluation of PPE. So finally, still on the principles is derecognition. So you see, you would derecognize PPE when it is disposed of. That is, when you sell it, or when you are not expecting any future economic benefit from it. So when you sell an item of PPE, just remove it from your books. So when an item of PPE is derecognized, you will majorly have to calculate a gain or loss on disposal. You would have to calculate a gain or loss on disposal. And this gain or loss on disposal is just done by comparing your disposal proceeds, which is how much you sold it, compare with the carrying amount. Then you have a gain or loss on disposal. That is the major thing you'll be required to do in the exam. However, if it is a revalued asset that was disposed of, that means that there might still be like a revaluation surplus in our equity. And since you have sold the asset, any revaluation surplus that is still remaining on that asset, you just need to transfer it to retained earnings. That means it has been earned. Just take it to retained earnings straight on, and you close that chapter from there. However, you need to know that when you dispose an asset, these are the entries you pass. First is that you need to close off the asset account. When you want to close an asset account, it's usually debit, so you credit it. Then you transfer that cost to the disposal account. Then the accumulated depreciation also should be closed since you have sold the asset. By debiting it, you transfer that balance to the credit of the disposal account. So in your disposal account, if you check the net, you'll be having a kind of carrying amount. Then the amount you sold the assets, you see, the amount you sold the asset is different from the cost of the asset. The amount you sold the asset is your sales proceeds. So the amount you sold it, of course, you're going to collect money, then you credit your disposal account. Saying from all of these entries you have passed, the balance in your disposal account will now be a gain or a loss on disposal. It should be a gain or a loss on disposal. So usually your exam mostly will not ask you to do this, but they can. But majorly, when you sell an asset, just know that we will need to get a gain or loss on disposal by comparing amount you received and the carrying amount, and that gives you a gain or loss on disposal. This gain or loss on disposal, just take it to your profit or loss statement. It goes to your P&L. Okay. However, I just went further to tell you, okay, the cost, that asset account itself, you need to close it. The accumulated depreciation needs to be closed. Then the money you received so your disposal account, the balance is like a gain or loss on disposal. So this summary here, for us to have this summary is usually gotten in a disposal account. But really, if you're able to do this, you end up is the resulting balance here is what you still come and get here. So you can simply just do this one if that's the only thing the examiner would always require us to do. And that is it for property, plant, and equipment. And there are some disclosures that you must show in the notes. One is the measurement basis, which could either be cost model or evaluation model, the depreciation method, the useful life. You need to do the gross carrying amount and the accumulated depreciation at the beginning and at the end. So this one is just speaking to that when you have your assets, you must go and do like a fixed asset schedule in the notes that will show the cost of the assets at the beginning, which is at the value at the beginning, and there will also be accumulated depreciation also at the beginning. Then you do a kind of reconciliation between the beginning and the end by showing all the new assets they bought, the ones they sold, and maybe there's impairment, all this other information that might be required. Okay, so we have looked at the principle. Let's start with this assignment I gave you, this past question. Let's start using that to solve questions. So this question was asked in November 2020. And what was this question about? So it said that Noodles Nigeria Limited manufactures various types of noodles in Oluyole for sale across the states in Nigeria. Now said recently, to continue to sustain leadership of the company in the Nigerian market, on September 1st, 2015, a brand new machine was bought from a supplier under the following conditions. So they gave us all of these figures up to the residual value. They now gave us the estimated useful life in units, 5 million units. Don't forget, I already told you that useful life can either be expressed in number of years or it can be expressed in number of units. In this case now, they expressed it in number of units. And they now gave us the actual outputs of these assets each year. So in the first year, these assets can do 1,000. In the second year, it can do 1, 2. In the third year, it can do 1, 4. And in the fourth year, it can do 800. If you add all of this together, you should get 5,000 or 5 million. If you don't get it, that means it can still go an extra 1 year with that balance. It can still go an extra 1 year with that balance. It now went forward that on 1st September 2016, he said that NNL Limited decided to upgrade the machine by adding new major components at a cost of 300,000. As a result of the new upgrade, there was an increase in the remaining life to 8 million. That shows that this 300 million should be capitalized. Because I told you that you only capitalized the subsequent costs. Because this is a subsequent cost that was incurred at the beginning of the second year. Because the end of the first year ended in October 2016. Right? Because the beginning of the year is September 1st, 2015. So this September 2016 is the beginning of the second year. They upgraded the machine with additional costs and it improved the useful life to 8 million. So that means this cost should be capitalized. Okay, and also, it also results in a change in the residual value to 114 million. It used to be 90 million before. So it has changed to 114 million. We now said that you are required to A, describe what is meant by depreciable amount within the context of IAS 16 on PPE, that for 1 mark. B, we are asked to highlight 3 characteristics of depreciable assets under IAS 16. And C, we are required to describe 2 models of accounting for cost of PPE under IAS 16. D, they say you should calculate the following: machine costs, revenue expenditure over the years, then the carrying amount of the machine over the years. Okay. Let's start from the simplest, from the A part. They said describe what is meant by depreciable amount. It's 1 mark, so we need to give them 1 mark answer. It's not even more than that. It cannot be more than 1 mark because depreciable amount is just your cost minus residual value. That's depreciable amount. Depreciable amount is cost minus residual value. And that ends us 1 mark. Then the B said that we should highlight 3 characteristics of a depreciable asset. I think when we say depreciable asset, one of the characteristics is that it must have a limited useful life. It must have a limited use. That is why we don't depreciate land. Because land has an unlimited useful life. So it is not a depreciable asset. So a depreciable asset must have a limited useful life. The second one is that a depreciable asset must a depreciable asset must be used for more than 1 year. Must be used for more than 1 year. That's another characteristics Another one is that a depreciable asset must be held for use for the production or supply of goods or services, rental to others, and for administrative purposes. So I've given you like 4 characteristics. And 2 of them, I got it from the definition. 2 of that characteristics from the definition of PPE I gave you. When I say depreciable asset must be held for more than 1 year, and it is held for production or supply of goods or services, rental to others, and for administrative purposes. And the other 2 I gave you is that it must have a limited useful life. A depreciable asset must have a limited useful life. So the next one is that they say we should describe 2 models of accounting for the cost of PPE under IAS 16. So this one is talking about, when they say 2 models, you should know that they are talking about that cost model and evaluation model. And they say we should describe it. And I've told you, cost model is cost minus accumulated depreciation minus accumulated impairment losses. But revaluation model is revalued amount or fair value minus subsequent accumulated depreciation. That subsequent is very important. And if you remember, when I was explaining revaluation, I mentioned something that whenever we revalue an asset, that all the accumulated depreciation to the date of revaluation must be written off. Yes, and that is why for evaluation model is always the fair value or the revalued amount minus subsequent accumulated depreciation, because we only take cognizance of depreciation going forward, then minus accumulated impairment losses. And that's it. Cost model is cost minus accumulated depreciation minus accumulated impairment losses. Revaluation model is revalued amount or fair value minus subsequent accumulated depreciation minus accumulated impairment losses. So all the solutions are here. Everything I've said, they are all here. So the next one is now saying that we should calculate the following. The first thing they ask us to calculate is machine costs. And how do we determine machine cost? It's just the initial cost. So it is now time for you to participate. I've been talking for the past 1 hour with 0 participation from you guys. So let's have little participation now. So I'll be looking at, they ask us to calculate machine costs. I'll be looking at these items one by one because they said they purchased the assets and these were the information given. So let's see which of these items will be recognized as a machine cost. Let's know which of them will not be recognized as a machine cost. Okay, so the first one, you can unmute now so that I just need your yes or no. The first one, supplier's invoice price. Supplier's invoice price, 500,000. Would this one, will it be added as part of the machine cost?
Yes, sir.
Okay, that's correct. Then there is trade discount of 25%. Trade discount applicable to invoice price of 25%. So what are we going to do with this trade discount? Are we adding or deducting? Are we adding or deducting?
Deducting.
Sorry?
We're not deducting.
Are we adding or deducting?
We're not deducting.
We are not deducting. We are deducting now. We will deduct trade discount. explained that last week. Trade discount should be deducted. So how much are we deducting? 25% of 500,000. How much will that give us? 25% of 500,000. That should be
125.
That should be 125,000. So that means we will deduct 125,000. Okay, the third one is discount applicable on invoice price for early settlement of 5%. I explained this one too last week. Early settlement discount. So they gave them early settlement discount too. So are we deducting this one? Are we deducting early settlement discount?
Early settlement discount.
Yeah. I'm scared for my students. You guys are not reading. No. I've forgotten. We even solved the question on this last week in the last class. Okay, I will tell you again. I hope you remember now. So early settlement discount will be ignored for the purpose of determining cost of an asset. Because I explained it last week that this early settlement discount is just if you pay early, you will get it. If you don't pay on time, you will not get it. So at initial cost, it has nothing to do with our initial cost at all, because it's not something you get. The one you get at the date you are buying the asset is this trade discount. They were even deducted it from your invoice. So it will have been removed. But this one, it will not. So even if you eventually meet up and pay early in the future, it's not even a deduction from cost. It's just like an income. That it will be a discount received in your books. You just simply treat it as a discount received. So please, you will always find this in your exam. They will always use it to come and distract you. Early settlement discount. Just ignore for the purpose of determining machine cost or cost of an asset. Early settlement discount should be ignored because you are not getting it right now. Even when you eventually get it, it's an income to you. It's just a reduction in your liability. It's a discount received, so ignore it. So please don't forget, we are still going to solve a question that has to do with this again. I hope you remember then. Then the next one is freight and shipment costs of 100,000. Freight and shipment cost. Are we capitalizing this?
Yes.
Yes. This is similar to initial delivery. Freight and shipment cost. Yes, should be capitalized. What about stevedore expenses? Do you know what stevedore expenses is? Who knows what a stevedore expense is? You can Google it. You will see it there. So it's the cost of loading and offloading. That is what Google said. Loading and offloading. So are we capitalizing that? The cost you pay for them to load the asset. Are we capitalize that one? Can we capitalize this loading and offloading?
Yes.
It should be capitalized. Okay. Let's look at the next one. That's correct. What about initial operating losses of 10,000? Would that be capitalized?
No.
No, it should not be capitalized. Initial operating losses. We mentioned this one. That's if you are making losses before you started using the assets, that should not be capitalized. So initial operating losses should be expensed. The next one is handling costs. Are we capitalizing handling costs? Are we capitalizing handling costs? Are we capitalizing admin costs?
Yes.
Yes.
Okay, yes. Hope you are not dubbing the answer. Then the next one is electrical and installation costs. Are we capitalizing that?
Yes.
Yes.
Okay, that's correct. How about interest on loan to the point of usage?
Yes.
No, this should not be capitalized.
Sorry. Yeah.
Yeah, interest on loan to the point of usage should not be capitalized. And the reason is because I think I mentioned to you that when you borrow money to buy an asset, okay, you can only capitalize the interests you are paying on that borrowing if that asset is an asset that you have to construct yourself. So any interest you are paying up to the date of when construction is complete, any interest you are paying on that borrowing should be capitalized. But as soon as the asset is completed, any interest you are paying should be expensed. In this case now, we didn't construct the asset ourselves. We bought a brand new machine. So the machine is already ready. So we now borrowed money to buy it. So it's not like we constructed it. So any interest we are paying on the loan should be expensed. So to the point of usage expensed, after usage expense, we're expensing all of this. Okay, next one, pre-operational expenses. Are we capitalizing this?
No.
No.
That's correct. We expense it. How about staff training? Are we capitalizing staff training?
Expense.
Yes, we expense staff training. That's correct. Professional and consulting fee on advice to buy the machine.
Capitalized.
That's correct. Purchase of a 4 years maintenance contract.
No.
What do we do to that? Are we capitalizing or expensing?
No.
Sorry, I can't hear you. Are we capitalizing or expensing?
Expensive.
Expensive.
That's correct. So we're going to expense this 120,000 over 4 years. It's a 4 years maintenance contract. So we just 120,000 divided by 4. That's 30,000 each over 4 years. The next one is pre-production testing cost of 13,000. Capitalizing or expensing?
Capitalized.
That's correct. Okay, and that's all. This one is a residual value. This one is for determining depreciation. Okay, so let's go and check the solution here. So we got everything correctly. As at this date, the date of when they bought the machine cost is the supplier's invoice, 500,000. We deducted trade discount, freight and shipment cost, stevedore, handling, electrical and installation, professional pre-production. That gave us an initial cost of 578,000. Okay. So we are done with the A parts. That's 3 marks. Now, the B part says that we should determine revenue expenditure over the years in the statement of profit or loss. Revenue expenditure over the years in the statement of profit or loss. So, which means that all the items we did not capitalize, all of them expenses. That's what they mean by revenue expenditure. So, looking at this solution, first one was depreciation. We will still come here because we don't know how they got it for now. So I'll leave this one for now. Then remember, initial operating losses we experienced, interest on loan to the point of usage expense, interest on loan after usage, pre-operational expenses, staff cost. You see this maintenance contract, it was expensed over 4 years, 30,000 each year. So what you require workings for you to calculate is this depreciation. This depreciation will require few workings. And which is the next question that asks us to determine carrying amount. And you know that when you say carrying amount, we are talking about cost minus accumulated depreciation. That is carrying amount. Anytime, any day. Carrying amount is cost minus accumulated depreciation. So for this now, how do we get our carrying amount? In determining this carrying amount now, we would also get this depreciation. So firstly, in the first year, which is 2000 and in year one, first, we need to get our depreciable amounts. Mostly, when you want to depreciate an asset, you need to get depreciable amounts, which might either be the cost if there is no residual value. But if there is residual value, you need to remove the residual value. So depreciable amount is cost minus residual value. The cost is 578 million. The residual value is 90 million. You might be wondering, where did we get this 578 million? That is what we worked out earlier on. 578 million. By the time you deduct 90 million, our depreciable amount is 488,000. So in year one, our depreciation, since useful life was given in terms of units, so our depreciation is, the unit in year one is 1,000 over total unit, which is 5,000. Where did I get this 1,000? They gave us an equation now. 1,000, the output in year one. So I just did 1 over 5,000 multiplied by the depreciable amount. Okay? And that gives me 97,600. And my carrying amount is simply the costs. Don't forget, it's cost minus depreciation, accumulated depreciation. My cost is 578. If you deduct 97,600, that is what gives you this carrying amount. In year two, ordinarily, depreciation for year two should just simply be 1,002 divided by 5,000 multiplied by 488,000. However, it won't be that smooth because something happened in year two. Something happened. If you look at this question, which is from 1st of September 2016, there was an additional cost that resulted in increase in useful life, and that also resulted in changes in residual value. So that means our depreciable amount will change. First, that upgrade is a subsequent cost, and subsequent cost will simply increase the cost of the asset. So it has increased our cost. So in my cost account or my asset account, the cost will now be 878 million. However, for my depreciation from year two, I will need to now recalculate my depreciable amount. I cannot use this as depreciable amount anymore. I cannot use this as depreciable amount anymore since there is additional cost and they have revised residual value. So my depreciable amount from year two going forward, because I'm done with year one, and this is my carrying amount at the end of year one. So from year two going forward is, where did I stop in year one? My carrying amount was 480.4, meaning carrying amount is, I've already deducted depreciation for year one. So this is what is remaining for me to depreciate over the remaining useful life. So for year two now, for me to determine the new depreciable amount, I start, okay, this was my depreciable amount before now, or my carrying amount. Now, there is an additional cost that I will now start depreciating from year two going forward, because this additional cost came in at the beginning of the year, at the beginning of year two. So I will add this 300. By the time you add these two guys, that gives me 780.4 million. I just simply deduct my revised residual value, which is 114 million, as given in the question. I was not the one that established it. They told us that the residual value was revised to 114 million. So I simply deduct my 114 million. Then my depreciable amount is 666,400. That's my depreciable amount. Don't forget, now that I've got my depreciable amount, now I'm ready to depreciate this depreciable amount over the remaining useful life. So what's the remaining useful life now? They told me that the output has been revised to 8,000. 8,000. If you look at this very closely, something happened. Because ordinarily, our total output was 5,000. And in year one, we had already produced 1,000. So ordinarily, my output that should remain should be 4,000 or 4 million. But as a result of this additional costs, they said it has increased to 8,000. That means my output has doubled. My output has doubled. If my total output has doubled from year two, that means the capacity from year two going forward will not remain this. In year two now, I don't expect my total output has doubled. In year two, will I still produce just 1,200? No. I'll be producing double of this also, which is 2,400. I'll be producing double of this in year three, which will result in 2,800. And I'll be producing double of this 800 in year four, which will result in 1,600. And that shows in how I calculated the depreciation from year two going forward. So you will see in year two, my depreciation is 2,400. I doubled that depreciation, that unit produced of year two of 1,002. I doubled it because my total output has doubled. So I cannot still go and be using 1,002. No, it will double. So I did 2,400 over 8,000 multiplied by the depreciable amount that I got here. That gives me my depreciation to be 199,920. Then my carrying amount, don't forget, carrying amount is always cost minus residual value. So since this 480,000 has already considered the deduction of depreciation in year one, so my costs will now be these 780.4. If I deduct this 199,920, that will give me my carrying amount of 580,480. In year three, my depreciation is 2,800, which I also doubled this output of year two. You see in the question, it was 1,400. It was 1,400. I doubled it also because my output has doubled. So 1,400 doubled to 2,800 divided by 8,000 multiplied by the depreciable amount. That gives me 233,120. By the time I do this carrying amount from the previous year minus depreciation for the current year, that gives me my carrying amount for this current year. In my year four, I doubled the output also to 1,800. Then that gives me over 8,000 multiplied by the depreciable amount. That gives me 133,280. By the time I remove that from this my earlier carrying amount, I have my carrying amount for this year as 213,960. In year five, the question didn't give me year five, but I know that if you add 24 plus 28 plus 16, it gave me 68. So that means they have not exhausted this unit. That means there's still an additional year. I just use that as the balance. The remaining 1,200 over the total output multiplied by the depreciable amount. That gives me 99,960. If I deduct that from my carrying amount, that gives me the carrying amount at the final year, which of course should equal to the residual value. Remember, the residual value was 140 million. So that should be the final value of these assets. That should be the final value of these assets. And that is it for this question. And then I can then go back here and fill in my depreciation. In year one was 97,600. This is the workings year. In year two was 199,920. This is the workings year. Then in year three and year four, like that. Okay, so that is it for this question. I actually gave you this question as assignment, so I'm not sure if any of you attempted it. Okay, do you have any question before we move to the next question? Okay, should we move to the next question?
Please, sir. I have a question.
Please ask.
Why are we doubling the output?
Oh, the reason is because the total output doubled. You know, when there was this additional cost of 300, the question told us that it resulted, if you look at the question, where is the question? There was an upgrade, okay? Then I said, as a result of this new upgrade, the remaining useful life of the output, it increased the remaining useful life to 8,000 or 8 million units. And for my analysis here, when I was explaining it to you, I told you ordinarily in that year too, because our total output before was 5 million, of let me shorten it, 5,000. And we have produced 1,000 in year one. The remaining should be 4,000. That is what the remaining is. But as a result of the subsequent costs, they told us in the question that it has increased to 8,000. 4,000 to 8,000. That's double. The examiner intentionally give you that proportion so that it will be difficult for you to double the others. If they are giving you maybe something like by 7,000 now, that it increased to 7,000 from 4,000, then that will be a very wicked examiner, because it will be difficult for you to now start knowing how you are going to increase the output of each year also. Because if the total increases, that okay, this is the capacity of this asset now, the capacity should be 4,000. They say it's now 8,000. That means what you can do each year should reflect that increase in capacity or increase in total output. So since the total output increased from 4,000 to 8,000 in year two, the output in each year should also increase by the same proportion, which is doubling. And that was the reason why we doubled each of the years. This one was just the balancing figure. They didn't really give us this in the question. But when I added this plus this plus this, you'll be having like 6 8s. So I'm sure that that means there's still remaining output of 1 2 for next year, which help us confirm that our final figure should be residual value. So that was why we doubled those output from year 2 going forward. Any other question? Any other question? Okay, so let's move to the next question. Okay, so these are practice questions. There are like 14 of them. So we are supposed to look at everything. So let's see. So the first question, this one says that an entity purchased an asset on 1st January 2006 for 10 million. They now said that the asset has a useful life of 10 years and uses straight line method of depreciation. Now said on 4th January 2009, the asset useful life is revalued to add a further 3 years to it. The asset has no residual value. The depreciation charge for the year 31st December 2009 should be, so they give us some options. Okay, so for us to do this, the key thing is this: the depreciation as at 4th January 2009 is just going to be the carrying amount divided by the remaining useful life. Because since this is not the first year, carrying amount over the remaining useful life, that's the depreciation as at the end of 2009. It's carrying amount. So whenever there's a change, maybe there's a change in the added additional useful life or the change residual value from the date of when that happened, for you to calculate depreciation going forward, you are going to have to get like a new depreciable amount okay, which is was the carrying amount at that date where that change happened. If there's any change in residual value, you just deduct the residual value, just like we did in the last question we solved, where there was a change in residual value, where there was an addition, a change in useful life in year 2. We started from carrying amount, we added the additional cost, we deducted the revised residual value to give us the new depreciable amount. This one is a bit straightforward than that. So carrying amount divided by the remaining useful life. So the carrying amount, first, as at the beginning of the year, where this change happened, where they changed the useful life to that date, carrying amount is always cost minus accumulated depreciation. So cost from the question was 10 million. So it's 10 million minus accumulated depreciation. So accumulated depreciation, we did the cost minus cost all upon the useful life, which is 10 million over this 10 million over the useful life, which is 10 years. So that gives me like 1 million. And I bought the assets in 2006. That means I must have charged depreciation in 2006, 2007, and 2008. That's I must have charged depreciation for 3 years, 1 million per annum, since they told us that they use straight line, which will give me the same amount of depreciation every year. So this 10 million over 10 years, that gives me the annual depreciation multiplied by 3 years. So 3 years. So that gives me 3 million. So 10 million minus 3 million, that gives me the carrying amount as 7 million. So I've gotten my carrying amount. So let me get my remaining useful life. My remaining useful life, ordinarily, since as at this date, I've already spent, that's 3 years because I bought the asset in 2006. But they now said that, okay, that means the asset should remain 7 years. But they said on this date, the asset useful life is revised to add a further 3 years. So that means from this 2009, 1st of January, the remaining useful life has now increased by 3 years. So it's back to 10 million. Sorry, it's back to 10 years. So my depreciation per annum is simply this carrying amount that we got here, all upon the remaining useful life, which is 10 years. And that gives me 700,000. And that's why our answer is A, which is 700,000. And that's the solution to the first question. Any question on this? Any question on this? Any question on this? Okay, let's move to question 2. Question 2 says that IAS 16 requires a revaluation surplus resulting from initial revaluation of PPE to be treated in one of the following ways. A, we credit to long-term provision and added to the PPE. B, released to income statement over the life of the PPE. C, debited to the class of PPE that is being revalued and credited to equity. D is credited to equity. What's the answer? You can see here that the solution is C, which is that we are going to debit the assets and credited to equity. And credited to equity. So that's the answer to that. Any question? Any question on that? Okay, so that means I can move to the next question. Question 3. This one states that an entity has a policy of revaluing its PPE. Okay. They now say that an asset costs 15 million on 1st of January 2008, has a useful life of 15 years, and is depreciated on a straight line basis to a 0 residual value. Okay. They usually has a policy of revaluing. The cost is 15 million on this. That means this is when they bought it. The useful life is 15 years and is depreciated on a straight line basis. Okay. Okay. The residual value is 0. They now say that the value of the asset at 31st December 2008 is 14.5 million. And that's like the fair value. That's the revalued amount. That means they revalued it on 31st December 2008. They didn't stop there. They said at 31st December 2009, they revalued it again. That's why they gave us market value. It was 12.5 million. They now said the accounting entry as at 31st December 2009 would be. So they give us some options. Okay. Let me leave these options for now. Let me show you how we will get it. Let me show you how we're going to work it out. So firstly, here I can see there's a revaluation. And I've told you earlier that whenever there is a revaluation, please, the first thing you should do, just to make everything look easy for you, is to get a revaluation surplus or deficit. So, and that's the first thing I would do on that date. On the date where they first revalued, I will get my evaluation surplus or deficit. And the way I do that is just by comparing my fair value to my carrying amount. My fair value from the question was 14.5 million, which is this 14.5 million. I will compare it with my carrying amount, and my carrying amount is always my costs minus accumulated depreciation. And my cost of my asset is 15 million, which is this. They told me my cost is 15 million, minus accumulated depreciation. Since they bought the asset that year, so that means I'll be depreciating for the first time. So it's just 15 divided by the useful life, which gives me 1 million. By the time I remove that from 15, I get 14 million. That means if I compare this 14 million, if I compare it with the fair value, I will see that the fair value is higher by 500, and which is a surplus. So there's a evaluation surplus of 500. In 2009, from the question, you will see that in 2009, they also revalued. So since they have revalued, I will need to get my evaluation surplus or deficit. And my fair value is 12.5 million. Compare that with my carrying amount. And my carrying amount and my carrying amount is simply, in this case in year 2 now, is my revalued amount of fair value since they revalued in the previous year. So that will represent like my costs now. And that's that 14.5 million. That's the most recent cost of fair value of that asset. Then I deduct my accumulated depreciation, which is that cost of fair value divided by the remaining useful life, which is 14 years. Remember, the initial life was 15 years. After 1 year, it becomes remaining will be 14 years. If you punch your calculator, it gives you 1,036. If you remove that from this 14.5, my carrying amount will be 13,464, which is higher than my fair value. That means I will have a revaluation deficit of 964. So that's it. Then how do I pass this in my books? Since we had a deficit, ordinarily we should just debit that deficit and take it to P&L. But don't forget, in the previous year, there was an earlier surplus. So that was why we need to net off the surplus first. That was why we debited the surplus with 500 to net off the surplus. So we have used 500 from this 964 to net off the surplus. The remaining 464 is what will now come in as deficit to my P&L. So I'm done with that deficit, and this 964 has been dealt with. The 500 of it went to net off this earlier surplus, debiting it. Then the excess of over and above the surplus went to P&L, both debited. Then I told you that whenever we revalue, any accumulated depreciation till the date of revaluation, in this case, as of 2009, the accumulated depreciation is 1036. That should be eliminated, should be cancelled out. And for us to cancel it out, we have to debit it, because ordinarily accumulated depreciation is a credit. To cancel it out, we debit it. So we debit 1036. Accumulated depreciation. Then our assets, the value before was 14,500. The value before was 14,500. Now it is 12,500. So we need to update my assets, my asset account, which was at 14,500. I need to update it to 12,000, meaning that I need to decrease it by 2,000. 14,500, it was 14,500. Now the fair value as that, because what we want to see in our cost account or asset account is 12,500 as against 14,500. So we reduce it by 2,000. Whenever we want to decrease the value of an asset, we credit. So we credit the assets with 2,000. If we add this side and this side together, 500 plus 464, it will give you, both sides will give you 2,000. And that's how you journalize or recognize the valuation of assets in your books. But don't forget the depreciation for the year, because we charge depreciation for the year of 136, and depreciation is debit depreciation in P&L. The other leg will go to your accumulated depreciation, 1036. So, and that's the solution to this question. If I want to look at the option, the correct option is going to be this, the A, which is depreciation of 1.04, which is this 1.04. So they just approximated this 1036 to 1.04. Then there is a fall in the value of 4.5 million charged to the valuation reserve, which is this evaluation reserve that we had to decrease when we had the deficit. So we went to net it off. We netted off the surplus. Of course, it will have become a reserve since it's coming from last year. So, and 0.46 million to income statement. So the excess over the 500 was 464,000, which they approximated here as 0.46 to P&L income statement. So from this is a more critical working, so we can easily know that A is the answer in this situation. And that's the solution to this question 3. So these are very deep questions. Any question on this one before we move to the next one? Any question? Any question? Okay. So let's move to question 4. This one said that on 1st of March 2000, UCACO acquired a machine from Planco under the following terms. They give us the list price, 82,000, import duty 1,500, delivery fees 2,050, installation cost 9,500, reproduction testing cost 4,900, purchase of a 5-year maintenance contract 7,000. Then I said, in addition to the above information, UCACO was granted a trade discount of 10% on the initial list price of the machine and a settlement discount of 5% also. If payment was received within 1 month, UCA paid for the machine as at. We're now required to calculate the cost of the machine. Okay, this is not new to us. So you might want to unmute and participate now. First, this listed price of 82,000, is it going to be part of the cost of the machine? Yes or no? Will it be part of the cost? Okay. The import duty, will it be part of the cost?
Yes.
Okay. What about the delivery fees?
Yes.
Okay, delivery fees will be added. What about the installation cost?
Yes.
Okay,
Yes.
added. What about pre-production testing cost?
No.
Yes.
Okay, what about purchase of a 5 years maintenance contract?
Expense.
Good. So we are going to expense it over how many years?
5 years.
5 years.
5 years. Not only that, they now said in addition to the above, there was a trade discount of 10% on the initial list price. So that will be 10% of how much was the list price? 82,000. That's 8,200. So what are we doing to that 8,200? Are we deducting it?
We are deducting it.
Yes.
Okay. Deduct 8,200. And also they say there's a settlement discount of 5%. So 5% of 8,200, that's like 4,100. What are we doing with that?
No.
What?
No.
Thank you very much. We are going to ignore that early settlement discount because ultimately this guy paid on time, right? He paid within that period that was given. So it will just go to your books as a discount received. It will go to your books as a discount received. So don't come and reduce it from the cost of the asset. Okay, fantastic. And that's the solution we have here. Okay. This is a mistake here. This should be 10%. This trade discount should be 10%. 8,200. Can you help me confirm if this answer is correct? You know that you have to be holding your calculator now since we are already in calculations here. Okay, should be 91,000.
91,750.
91,750. Okay. Okay, let's look at solution 5. This one says that.
Sorry to take us.
Okay, Kayode.
I want to ask, so what if he's not able to make payments for that discount that was given?
Lose the discount. It will not even come in as discount received.
Okay, all right, thank you.
Okay, question 5. A construction of armed school new store began on 1st of April 2001. The following costs were incurred in the construction. They give us all of these costs. We're now told that the store was completed on 1st January 2002. Okay, when did they start it? 1st April 2001. Okay, that was how many months now? And they started using it on 1st of April. Okay. We're now told that AMCO took out a 25 million naira loan on 1st of April, okay, which is when they wanted to start construction, to aid construction of the new store, which means the definition of a qualifying asset under S23. Like what I told you, whenever you borrow money to construct an asset, the interest you pay to the bank should be capitalized up to the date of completion. So the loan carried an interest rate of 8% per annum and repayable in 2004. Okay. We're now required to calculate the amount to be included as PPE in respect of the new store and describe the impact that the above information will have on the statement of profit or loss for the year ended 31st March 2002. Okay. So again, let's pick it one by one. The cost of the land, will it be capitalized?
Yes.
What about architect fees?
Yes.
What about site preparation costs?
Yes.
Okay, that's correct. What about material costs?
Yes.
Cost of material. Should it be capitalized?
Yes.
Okay, that's correct. What about direct labor costs?
Yes.
That's correct. What about legal fees?
Yes.
That's correct. What about general overhead?
No.
Okay, general overhead should be expense. That's correct. So remember, they took out a loan of 25 million and they are paying interest of 8% per annum. Can you help me do 8% of 25 million? Or just make it simple. Do 8% of 25,000. Remove those 3 zeros. That gives me 2,000. But that is the interest for year one, for the first year. However, we took out the loan on 1st April. Coincidentally, that was when we started construction. But construction was completed on 1st of January 2002, which is equivalent to 31st December 2001. So that means this construction took only 9 months. Yeah, 9 months. So that means that 2,000, we're going to prorate it by 9 months. So just 2,000 multiplied by 9/12. That will give you the amount of interest that should be capitalized. Any other interest after the date the construction is complete should be expensed. And in this solution is well shown here. We capitalize the cost of the land, architect fees, site preparation, materials, direct labor costs, and legal fees, and also the borrowing cost. But like I mentioned, 8% of 25,000, I prorated it only by 9/12, so that we'll be capitalizing only the portion up to the date of completion of construction. After the date of completion of construction, any interest are still paying to the bank must be expensed. That cannot be capitalized. Okay. Any clarification you need before I move to the next question? Do you need any clarification? All right.
Okay.
So let's move to question 6. This one says that on 1st of March 2002.
Sorry, boss.
Okay.
What's the impact? There's a question on that first layer that said, what's the impact on the P&L?
Okay, so like I've mentioned, for this first year now, the remaining 3 months will go to P&L. That means the remaining 500,000 should go to P&L. And also this general overhead should go to P&L. And that's it.
Okay, thank you very much. Okay, thanks.
Okay, question 6. This says that on 1st of March 2002, Yukaco purchased an upgrade package from Plantco at a cost of 18,000 for the machine it already purchased in 2000. The upgrade work took a total of 2 days, where new components were added to the machine You can agree to purchase the upgrade package as the new component will lead to a reduction in production time per unit of 15%. This will enable UCA to increase production without the need to purchase a new machine. Explain whether the additional expenditure should be capitalized as part of PPE or expensed to the statement of profits or loss for the year ended 28 February 2003. Okay, I've told you this is a subsequent costs. It's an upgrade package. Subsequent cost of 18,000. And like I told you, you can only capitalize these costs if it will improve the productive capacity of the asset and if it will also improve the useful life of the asset. In this case, it will increase the productive capacity because it would result in a reduction in production time by 15%. Therefore, this 18,000 should be capitalized. And that's how you're going to explain it. Okay? That's how you explain whether it should be capitalized. First, state the criteria for capitalization, even though what the standard said is that before you can capitalize the subsequent cost, it must meet the recognition criteria, which is that it must be probable that it will generate future economic benefit, and it must have a cost that can be measured reliably. However, I went further to tell you that what that means is that these subsequent costs must improve the productive capacity of the asset, and it must also improve the useful life of the asset. Therefore, because this 18,000 meets one of that, it means that it should be capitalized. So I've explained that here in this solution. Any question on that before I go to question 7? Any question? Okay, so let's go to the next question. This one says that, question 7, that a machine was purchased on 1st April 2000 for 120,000. It was estimated that the asset had a residual value of 20,000 and a useful life of 10 years on this date, which is this date, 1st April 2000. We're now told that on 1st April 2002, the residual value was reassessed as being only 15,000, and the remaining useful life was considered to be 5 years. Demonstrate how the machine should be accounted for in the years 31st December 2001, 2002, and 2003, and prepare an extract of the statement of profit or loss. Okay. I think we have solved something similar. What has happened here is that from these dates, they change the useful life and they change the residual value, and they also change the useful life. So let's see. First thing, I started from year 1. Since they asked me to calculate how the machine will be accounted for in year 1, year 2, and year 3. So in year 1, my depreciation first is going to be this 120,000 minus the residual value, which is 20,000, divided by the useful life of 10 years. That gives me depreciation per annum of 10 years. So my carrying amount is simply cost minus accumulated depreciation. And my cost is 120,000. My accumulated depreciation is 10,000 in year 1. That gives me 110,000 as carrying amount. In year 2, my depreciation is still going to be 10,000 because nothing has changed. So it's still that 10,000. My carrying amount is my cost, which is 120,000, minus accumulated depreciation of 20,000 now, which is 10,000 in year 1 and 10,000 in year 2, making 20,000. My carrying amount is 100,000. In year 3 now, things have changed. There was a change in residual value, there was a change in useful life, And whenever we have that, I've told you already that depreciation will be the carrying amount over the remaining useful life. And the carrying amount before this date was 100,000. That was why we had 100,000 here. Minus the reassessed residual value. This reassessed, the reassessed residual value to be 15,000. So we remove it. Now, they now said the useful life is now 5 years. He said the useful life is just 5 years now. So we divide it by 5 years. So that gives me 17,000 if you press your calculator. So my carrying amount is my cost, which still remains 120. All this we just did is just for calculating depreciation. My cost, my asset account will still remain 120. It doesn't change. It will be there. Now, my accumulated depreciation is now 37,000. Don't forget, it was 20,000 up to last year. This year now, we have charted 17. It has increased to 37. So my carrying amount is 83. In my PRL, for the year ended 2001, 2002, 2003, these are my depreciation that goes to PRL, 10,000 in year 1, 10,000 in year 2, and 17,000 in year 3. In my statement of financial position, my carrying amount, my cost doesn't change in all the years. But my accumulated depreciation in year 1 was 10,000, giving me my carrying amount as 110. My accumulated depreciation in year 2 is 20,000, giving me my carrying amount to be 100,000. My accumulated depreciation in year 3 is 37,000, giving my carrying amount to be 83,000. And that is all for this question. So it just has to be systematic like that, step by step, and you will never get it wrong. Okay. Any question before we move to the next one? Any question before we move to the next one? Okay, no questions. So let's move to question 8. This question says that a company purchased a property with an overall cost of 10 million on 1st of April 2001. The separate components of the property is made up of the following. There is land and building. The land is 20,000, but the entire land and building is 65. If the land is 20,000, that means the building is 45,000, which is 65 minus 20. But the useful life is 50 years for both. Majorly for the building, land has an unlimited useful life. For the fixtures and fittings, the cost is 104, the useful life is 10 years. The lift cost is 11, the useful life is 20 years. So giving us this total of 100 that they were referring it to here. So what this question wants to teach you is that whenever we have an asset that has separate components, and each separate component has its own useful life, it means that you have to depreciate it of those components separately. So this question asks us to calculate annual depreciation for the year end 2002. So the annual depreciation, we will get the building, which is 45,000. We cannot depreciate land, so that's why we remove this 20,000 from 65 to give us 45,000. Divided by the useful life, which is 50 years. And that gives us 900. The fixtures and fittings, cost is 24,000 divided by the useful life of 10 years. This 10 years here. If you punch your calculator, you get 2,400. The lift is 11,000 from the question. This 11,000 here. The useful life is 20 years, which is 20 years here. If you do your pressure calculator, you get 550. If you add them together, it gives you 3,850. So what this question is teaching you is that when you have an asset that has separate components, and each component has its own separate useful life, you have to do your depreciation separately. So any question before I move to the next question? Any question? Okay, then. Let's go to question 9. Question 9. So this one states that a company purchased a building on 1st April 2001 for 100,000. We're now told that the asset had a useful life of 40 years. We're now told that on 1st April 2003, the company revalued the building to its fair value of 120,000. Required. Calculate the revaluation gain and prepare the journal entry to account for the revaluation. Calculate the revaluation gain and prepare the journal entry. Okay, of course, whenever there is revaluation, I've told you that the first thing you need to do is to determine your revaluation surplus or deficit, and which is what we are doing first in our solution. And when did the revaluation happen? It happened on 1st April 2003. That was when the revaluation happened. And to get our revaluation surplus or deficit, we simply compare the carrying amount to fair value. First, we determine our carrying amount here, which is the cost minus the accumulated depreciation. And the cost from here, from this question, is 100,000. So we have 100,000. My accumulated depreciation up to the date of revaluation is 100,000 divided by 40 years, because the useful life is 40 years. That already gives me my depreciation per annum. But because I bought this asset on 1st April 2001, that means up to this date, I must have depreciated for 2 years, which is the end of that year, which is March 2002, and the end of the second year, which is March 2003. 2 years depreciation from April 2001 to April 2003. We have depreciated for 2 years. That's why I multiply by 2 years. So I can get my accumulated depreciation of 5,000. If I remove that from this 100,000, that gives me 95,000. Then I will compare that carrying amount of 95,000. I will compare it with my fair value. And from the question, they gave me the fair value as 120,000. So this is 120,000. If I compare that to this 95,000, I will have a evaluation surplus of 25,000. That goes to my evaluation surplus account. And that is it for this question. However, the question did not stop there. The question said we should determine the journal entry. So my journal entries for this evaluation, whenever there is evaluation, it goes to OCI. It's an unrealized income that will end up in equity. So I credit my evaluation surplus. Then I need to increase the value of my asset. Initially, the cost of my asset was 100,000, but now it has increased to 120,000. That means I'm increasing from 100,000 to 120,000. That's a 20,000 increase. That is why I'm debiting my building by 20,000. And I've told you that whenever we revalue an asset, the accumulated depreciation up to the date of evaluation must be written off. And the accumulated depreciation we have computed that year already as 5,000. That I will debit to cancel it out. When I do that, I will put my narration, because this is a journal entry, which is being evaluation of building. And you will see that my debit is 25,000 and my credit is also 25,000. So this question has taught you how to calculate evaluation and how to put it in your books through journal. Any question on question 9? Before I move to question 10. Any issue on question 9 before I move to question 10? No issues. Okay. Let's go to question 10. This one says that the carrying amount of Zenco's property at the end of the year amounted to 108,000. So they are giving me carrying amount straight on. They now put in bracket that this carrying amount is cost or value of 125,000 and an accumulated depreciation of 17,000. Of course, if you do this 125,000 minus 17,000, it will already give you 108,000. We now say that on these dates, meaning on the day they gave us this carrying amount, they said the property was revalued and was deemed to have a fair value of 95,000. They now went further and said that the balance on the evaluation surplus relating to a previous evaluation gain is 10,000. They are saying that there was a previous evaluation gain of 10,000 on this asset. We're now required to calculate the revaluation loss and prepare journal entry to account for the revaluation. Again, there was a revaluation, and whenever there is a revaluation, the first thing we need to determine is revaluation surplus or deficit. And that we do by comparing carrying amount with fair value. Since this question has already given me my carrying amount on a platter of gold as 108,000, so I quickly use it. I compare that with my fair value of 95,000, which is 95,000 here. Since the fair value is now lower, that gives me a revaluation deficit of 13,000. My journal, first, since there was a previous evaluation gain or surplus of 10,000, this 13,000 deficit cannot go to P&L as a debit. First, 10,000 of this 13,000 will go and net off this earlier surplus. That's why we are having equity or OCI. It eats my revaluation surplus, that 10,000. That earlier surplus, this 13,000 deficits we're having this year, first, you can don't take it to P&L. Go and eat it against the previous surplus first. And that's why we are debiting that surplus here. And there is remaining 3,000, meaning this 13,000, the excess over that 10,000 that has been written off from this 13,000 is that one that will now follow its natural course and go to P&L and call it a revaluation deficit. Thereafter, look for any accumulated depreciation till the date of revaluation, which is this 17,000. That was the accumulated depreciation at the date of revaluation. It should be written off, so we debit it. Thereafter, our asset initially, the cost of the asset was 125,000. Now, it has been updated with fair value to 95,000. That means we need to decrease it by 30,000. Decrease it from 125 to 95. And that is why we are crediting this asset to 30,000 so that it can decrease from 125 to 95. So we credit. You will see that my total debit is 30,000. If you add them together, we jives with my total credit of 30,000. And that is it for question 2. So this question only teaches you that whenever there is an earlier surplus, you need to go and net that off before you go and recognize any excess deficit to P&L. Any question on this one before I move to question 11? Any questions? Any question before we move to question 11? Okay then, let's move to question 11. So this one said that a company revalued its property on 1st April 2001 to 20 million, 8 million of which is related to land. It revalued on 1st April 2001, okay? They now went ahead to say that the property originally cost 10 million, 2 million of which is related to land 10 years ago. They now said the original useful life is 40 years for the building is unchanged. The company's policy is to make transfer to retain earnings in respect of excess depreciation. Okay, good. That means we have to do excess depreciation since the question told us, I told you that if they don't talk about excess depreciation, that is the company's policy to make transfer to retain earnings in respect of excess depreciation. Don't even go there. That's why I've not even mentioned it since. But now the question has mentioned it in question 11. So required, we're asked to prepare all the necessary journal entries to account for this property for the year 31st March 2002. We are also asked to prepare an extract from the following financial statements for the year ended 31st March 2002. We are asked to prepare a statement of profit or loss and other comprehensive income. We are also asked to prepare a statement of financial position. We are also asked to prepare a statement of changes in equity. Okay, just like we have been doing over several questions, at least from question 8, I've told you that whenever there is a revaluation, the first thing you do is to determine your revaluation surplus or deficit at the date of revaluation. And in this question, when was the date of revaluation? The date of revaluation was on 1st of April 2001. First of April 2001. That's the date of revaluation. So at that date, we'll simply compare my carrying amounts. I'll compare it to my fair value. And my carrying amount is simply my cost minus accumulated depreciation. And my costs of this asset from this question is 10,000, which is this 10 million here. So these 3 zeros makes it 10 million. I just put it like this to make it easy to look at. Then my accumulated depreciation is my cost over the useful life. I had to remove this 2,000 because land is not depreciated. Out of this 10 million, 2 million relates to land, which is not depreciated. So I removed it, divided it by the useful life, which is 40 years. But don't forget, at this date, 2001, this is after 10 years, because they said this asset was acquired 10 years ago. So that means they must have depreciated this asset for 10 years. By the time you do 8,000 over 40 years times 10 years, it gives you 2,000. And this is my accumulated depreciation. If I remove that from the cost of these assets, that gives me my carrying amount as 8,000. I compare that with my fair value, which in this question is 8,000. Please don't go and mistakenly remove this 8 million that is related to land. This one is just in case you want to calculate depreciation. But for evaluation, is the fair value for both assets is 20 million. This 8,000 is also for both assets because this cost for both assets is only in determining depreciation that we did not consider land. Okay, so my fair value is 20 million, which is higher than my carrying amount of 8 million. That leaves me to my depreciation. That leaves me to my evaluation surplus of 12,000. However, since this evaluation surplus was done, or this evaluation was done at the beginning of the year, and the year end is 31st March, so at the end of the year, I will have to calculate my depreciation for the year. And in doing my depreciation, I will now use the new value, which is the fair value. But since it's depreciation I want to calculate, I will have to now remove the value relating to land as given here, 8 million related to land, because land is not depreciated. By the time I take 20 from 8, I get 12,000. The remaining useful life from the date of evaluation is 30 years. This, since they said as at the date of evaluation that the asset was acquired 10 years ago. So that means it's 10 years. And the original life of the asset is 40 years. That means from the date of evaluation, which is 10 years after the date of acquisition. So the remaining life of the asset is going to be 30 years. So my remaining life is 30 years for the asset. So depreciation is going to be this 12,000 all upon the remaining life of 30 years. And that gives me 400,000. However, since they told me that these companies usually make transfer to retain earnings in respect of excess depreciation, So I need to determine my excess depreciation, which is simply by looking at what was the old depreciation I was charging before, which is before the date of evaluation, my depreciation is the 8,000, which using the cost over the useful life, 40 years. So I was charging 200,000 per annum. But after the date of depreciation, after the date of revaluation, my depreciation from what we did here is simply 12,000 divided by 30 years, which will result into 400,000 per annum. So the depreciation after evaluation has increased by 200, which we call excess depreciation. And you will see how we record that. Like I told you earlier, you just simply transfer it from revaluation reserve to retained earnings every year. So my journal entries for all this we have done, let me start with my revaluation. First, I had a surplus of 12,000. So that goes to credit, 12,000. My asset, since the cost of my asset was initially 10,000, and now I need to update it to 20,000. So that means I need to increase it by 10,000. So I'll debit my asset by 10,000 to increase it. Then the accumulated depreciation till the date of evaluation, which you computed here as 2,000, that has to be written off. And that is why we debited it, 2,000. The debit side, 12,000. Credit side, 12,000. It jives. Secondly, is this depreciation of 400,000 for the year, for that current year? For depreciation, you simply debit your depreciation to P&L of 400,000, and you credit your accumulated depreciation with the same amount. And my narration is being depreciation charge for the year. And finally, is this excess depreciation. I simply debit evaluation surplus, taking it away, or any need from evaluation surplus, I debit it to decrease my evaluation surplus, decrease it. And I transfer it to my retained earnings, credit that, being transfer of excess depreciation to retained earnings. And that's my journal for these transactions. Then I was also asked to prepare my statements. First is my statement of profit or loss and other comprehensive income. My PRL, my depreciation expense for the year of 400,000 goes to my PRL. In my OCI, my evaluation surplus of 12,000 goes to my OCI. In my extract of statement of changes in equity, my evaluation surplus and my retained earnings are the major relevant items here that goes to equity. My evaluation surplus for the year was 12,000. Since this company usually transfers excess depreciation, we have already said here that we debit evaluation surplus and credit retained earnings. And that is why we are removing that 200 from evaluation surplus here, and we are adding it to retained earnings here. In my statement of financial position, my land and building, the updated cost is 200. The subsequent accumulated depreciation going forward is 400. That leaves my carrying amount to 19,600. Then under my equity, I simply have my retained earnings to be 200, which is this 200. And I have my evaluation surplus to be 11,800, which is this minus this, which I've also put here for you. That gives me 11,800. Okay, this is more tedious than the previous ones we have done. Is there any aspect of it you don't understand for me to re-explain? Any aspect? Any aspect? Okay, so now the next question, which is question 12, This one said that a company purchased a building on 1st April 2001 for 100,000, at which point it was considered to have a useful life of 40 years. We're now told that at the year end 31st March 2006, that the company revalued the building to its fair value of 98,000. And the company's policy is to make a transfer to retain earnings in respect of excess depreciation required. We pay any necessary journal entries to account for this building and prepare extract from the following financial statements: statement of profit or loss, statement of financial position, and statement of changes in equity. Okay. Again, just like we have always done, whenever there is evaluation, the first thing you need to always do is to calculate the valuation surplus or deficit at the date of evaluation. And when was the date of evaluation here? It was 31st March 2006. That was when they revalued the asset. So as at this date, 31st March 2006, which is the date of evaluation, we simply compare the carrying amount with the fair value. And my carrying amount, which is my cost minus accumulated depreciation. My cost from this question is 100,000. My accumulated depreciation is my cost all over the useful life, which is 40 years. That gives me depreciation per annum. And since the date of evaluation is 31st March 2006, and we acquired this asset on 1st April 2001, that means we must have depreciated from April 2001 to March 2006, which is March 2002, March 2003, March 2004, March 2005, March 2006. 5 years. That's why I multiply this one by 5 years, so that I can get my accumulated depreciation till this date. Doing the math gives me 12,500. If I remove that from my 100,000, that gives me my carrying amount to be 87,500. Then I can compare my carrying amount to my fair value. And in the question, I was given my fair value to be 98,000, which is higher and above this carrying amount. And that leaves my evaluation surplus to be 10,500. Okay, so this one also determined depreciation for the year. So, which is already determined as part of this one. So I just expressed it out for you here. So it's still 100,000 over 40 years, which is 2,005. So that's how we will still do our depreciation for that year, since this evaluation took place at the end of the year. So then what is my excess depreciation? So since this evaluation took place at the end of the year, that means there is no new depreciation yet. We have not calculated. It's still this one for the year is still the old depreciation. So that means we don't have any excess depreciation for this year. So there's nothing for excess depreciation. So my journals, first, my evaluation surplus will go to credits, which is 10,500. My assets, the cost of my asset is 100,000. I need to reduce it to 98,000, which is reduction by 2,000. For me to decrease my asset, I credit it by 2,000. Then, whenever we revalue, the accumulated depreciation till the date of evaluation must be written off or cancelled out. And that is why I'm debiting this accumulated depreciation by 12,500. So my debit side is 12,500. My credit side is 12,500. And my narration being evaluation surplus. Then my depreciation for the year, I simply debit depreciation, I credit accumulated depreciation, just to show the depreciation charged for that year. In my POL, my depreciation expense in POL is 2,500. I had a evaluation surplus of 10,500. My statement of changes in equity, I simply have only evaluation surplus for the year, which is 10,500. And my statement of financial position, my assets is going to be are the value as at that date, which is 98,000. That's the value as at that date. Is the value as at that particular date is 98,000. And in my equity, I have my evaluation surplus, 10,500. So this 98,000, since that's the updated value as at the year end, since this evaluation was done, that's why I'm having my carrying amount now to be that favor. I didn't even have to remove depreciation because the accumulated depreciation has been cancelled out at the date of evaluation, which is the year end. So my value going forward is 98,000 add from the year end. And that's why I have this 98,000 here. Okay, so this is almost similar, but it's teaching you that when evaluation is done at the year end, so your value will just be that revaluation, and depreciation for that year will still be determined using the cost of the asset, the cost as the beginning, which gave us this 2005 year. Okay, that's the end of this question. Do you have any question?
So there was a question around the excess depreciation.
Yes, I've already explained that there is no excess depreciation since there is no new depreciation. It's still the old depreciation we have determined. The revaluation was done at the end of the year.
Okay.
Not calculated any depreciation using the revaluation to evaluate amount.
Absolutely. Thank you.
So the next question. So this says that at 1st April 2001, HD Co. carried its office building in its financial statement in its original cost of 2 million, less accumulated depreciation of 400, based on its original life of 50 years. HD Co. revalued the office building on 1st October 2001 to its fair value of 2.2 million. The remaining life was reassessed at the time of evaluation and is considered to be 40 years at this date. Company's policy is to make a transfer to retain earnings in excess in respect of excess depreciation. We are required to prepare any journal for this building during the year ended at 1st March 2002. We're also required to prepare extract on the following financial statements for the year ended at 1st March 2002. Statement of profit or loss and other comprehensive income, statement of financial position, and statement of changes in equity. Okay, again, whenever there is revaluation, the first thing we need to determine is revaluation surplus or deficit at the date of revaluation. In this question, the date of revaluation was 1st October 2001. So to determine evaluation surplus or deficit, we'll simply compare my carrying amount to fair value. Compare carrying amount to fair value. And my carrying amount is my cost minus accumulated depreciation. My cost from this question is 2 million. It's 2 million. So I have 2 million here. I deduct my accumulated depreciation. However, they have already given me accumulated depreciation till 1st of April 2001, which is 400,000. So I have my accumulated depreciation brought forward, 400,000. However, the date of evaluation was 1st October 2001. So I need depreciation from April 2001 to 1st of October 2001. That's 6 months because April, May, June, July, August, September, that's 6 months. So for me to do that, my depreciation for this period is going to be my cost, which is 2 million, divided by the useful life of the asset, which is 50 years. That gives me the depreciation per annum. Since this is a 6-month period, I'll just prorate that by 6/12, and that gives me 20. If I do this minus the accumulated depreciation, that gives me 1,580. I will compare this 1,580 with my fair value, which is 2,200. Then I have my evaluation surplus because since the fair value is higher and above this carrying amount, I have an evaluation surplus of 620. Secondly, I will need to determine my depreciation for the year. Since the year end is 2002, from the question, you will see that it's 31st March 2002. I have my fair value now to be 2,200 from 1st of October. And from the question, the revised useful life is, the remaining useful life is now 40 years. Therefore, how do I get my depreciation per annum? So this year started from 1st April 2001 and it ended October. However, since the evaluation was occurred the 1st of October, so the way I will calculate my depreciation for the first 6 months will be on the initial cost over 50 years multiplied by 6 over 12. That gives me 20,000, just like I did here. It's just the same thing. Then for the remaining 6-month part of the year, after revaluation, now I'll be using this new revalued amount and I'll be dividing it by the remaining useful life of 40 years. This gives me the depreciation per annum. Since this is a 6-month period, I prorate it by 6 over 12, and that gives me 27,500. Then I will add the two together. That means my depreciation for the year is 47,500. Finally, since they told us that is this company's policy to transfer excess depreciation, therefore I need to get my excess depreciation, which is just comparing my old depreciation for this current year. For this current year now, before the revaluation, my depreciation was 20,000 before revaluation. After revaluation, my depreciation is now 27,500. So my depreciation has increased by 7.5, and that's my excess depreciation. And I try to give you some notes here. Okay, because this is like a evaluation during the year. And this is like the most advanced question you can ever have in any exam. So my journals. First, my evaluation surplus of 620 goes to credit. OCI, credit. Then my asset, if you look at my asset, the cost of my asset was 2,000. Now it has updated to 2,200. So I need to increase it by 200. And that's why I debited it by 200. My accumulated depreciation up to the date of evaluation is this 400 plus this 20, and that's 420. I have to eliminate it, and that's why I'm debiting it, 420. Total debit, 620. Total credit, 620. Secondly, is my depreciation for the year, which I simply debit depreciation to P&L. I credit accumulated depreciation, being depreciation charged. Then transfer of excess depreciation, that excess depreciation of 7.5, I remove it from my evaluation surplus through a debit. I credit to my retained earnings, being transfer of excess depreciation. In my PRL, my depreciation for the year was 47.5 as computed above, which I even have here. In my OCI, I have my evaluation surplus of 620. In my equity, the relevant items in equity for now is this surplus and retained earnings. The surplus earlier was 620. Okay. If it's like this, then this should not be here. It's actually 620. Then I transferred to retained earnings. So I removed 7.5 and I put it here. Since I'm not putting the total, let me just remove it. So that gives me my statement of changes in equity. My statement of financial position, then my cost is 2.2 million minus subsequent accumulated depreciation, which is 27.5. That's the depreciation after revaluation. This one, 27.5. And that's the only one I will remove. And that gives my carrying amount to be 2172.5. This minus this. And in my equity, I have my retained earnings and my evaluation surplus. So the only difference in this and what we have been doing is the fact that the evaluation occurred during the year, and we had to separate the depreciation for the year, the one before evaluation using the cost, the one after depreciation using the new value and the remaining useful life. And that's just the only difference here. Any question before we solve our last question for today? So let's solve the last question for today. Question 14. This states that an asset originally cost 16,000 and had an accumulated depreciation of 8,000, was disposed of during the year for 5,000. Explain how depreciation should be accounted for. Okay. No, not depreciation, disposal. Okay, this is a question of on disposal. So first, the asset and its associated accumulated depreciation should be removed from the statement of financial position. And a loss of 3,000 should be recorded in the P&L. That is, we get our carrying amount by comparing my costs, which is 16,000, as given in here. I deduct my accumulated depreciation of 8,000. That gives me 8,000. I compare that with my sales proceeds, which is 5,000 here, as given in the question. That gives me a loss on disposal of 3,000. So this one is always straightforward when there is loss on disposal. Now, this question 15, you have to go and attempt it yourself. I'll probably still solve it for you, but just look at it. This is just going back to published, giving you a trial balance. And based on what you have learned now, they gave you some additional information so that you can use it to prepare your statement of profit or loss and statement of financial position. Though the solution is there for you. Solution is here for you. It's a long solution. And there are other questions here, past questions here, that I need you to practice. It's important you look at them, practice them. All of these are for your practice. So next week, we are going to be starting with intangible assets next week. So let's see, hopefully we'll be able to start and finish this next week. So this marks the end of today's class. And today is the first time we are going to use our complete time. Before now, we have been closing earlier than usual. So, expect that going forward, we will be spending an elongated time because I'll be having a lot of questions to solve. So for us to complete it, we have to complete our time because we are done with theory. So now, as soon as after we have completed the theoretical, we'll go to working. So we're going to be spending a lot of time. So like when I finish teaching you intangible asset now, I'm probably still going to come back here and solve. We're probably going to look at this question together, but I will expect that you also look at it, this particular question. So, and it will take some of our time. So next week also, we'll be going a long stretch from our 5 to 8, which is our normal time. Okay. So do we have any question? Do we have any question? Okay. If we don't have any question, thank you and have a wonderful night. Bye-bye.
Thank you.
Thank you. Thank you.
Thank